Welcome to the Evolution Partners podcast, where I talk with the world's leading thinkers, planners, and doers who are helping to build great companies in their own way. We learn how the work they're doing is creating an impact and get to know a little bit more about them and what makes them tick. This episode is brought to you by Evolution Partners, where we help leaders to confidently build enduring great companies using our proven, structured, strategic planning process that ensures you build and execute the right plan. Check us out at evolutionpartners.com.au. Also, you can check out our books, Made to Thrive, outlining how to be a great CEO, as well as Onboarded, which is about making your new hires more effective faster. Miltz is a thinker and a doer. He's the co-founder of Cashflow Story, software that's been adopted by tens of thousands of businesses in more than 90 countries, and he sits on 15 company boards. He's also the co-author of Scaling Up, where his work on cash has become a cornerstone for mid-market companies around the world. His frameworks, from the 4 chapters of financial performance to the Power of One, have become essential tools for CEOs who want to turn numbers into a story, improve cash, and increase business valuation. Alan, welcome to the podcast.
And good morning to you on a Monday morning from Melbourne, Brad. Always super excited to talk to you and sharing with your great listeners some knowledge hopefully I can impart today.
Indeed, indeed. I am very excited myself. The first time we met, the first time I came across you was in 2009, and you were presenting at MIT for the Entrepreneurs Organization. And at the time, you had software products that the banks use, and I think it was like more than 500 banks that they were using to evaluate whether or not company has essential cash flow to earn the loan or to be able to qualify for the loan. So I guess that was before you wrote, or you were involved in writing as a co-author Scaling Up, before the software that's now available. You've had a deep and long experience in cash flow and I guess small to medium-sized businesses, what makes their financials work. What's been the most rewarding part of this work for you?
So, Brad, when you explain it that way, I think, wow, time has gone quickly. I think probably I've dedicated over 30 years of my life to making people love the numbers. The numbers tell a story. The problem is everyone tells the story in a different way. And my story is told by banks, accountants, companies. And over my career, I've dedicated my life to enabling everyone to speak the same language. And the language is about cash flow, growing your profit, growing your cash, and growing your valuation in a non-threatening, simple way. It's been all about simplicity.
I can almost still remember being in that room. It's an understanding from you at that very, I guess, superficial level at that point, because it's so hard for entrepreneurs to understand the numbers, the working capital, how things work and flow. So, yeah, I mean, why do you think it's so hard for entrepreneurs to get these numbers without the framework like yours?
So a story of numbers is told over 4 chapters. It's like reading a book. Every CEO I ever meet is a chapter 1 profit expert. So everyone looks at their revenue, their margins, their profit, and that's why one of the sayings that I'm known around the world for is revenue is vanity, profit is sanity, and cash is king. And everyone nods their head when I make that statement, but no one knows what their cash flow is. So it's been an amazing journey for me to try and explain that your story, which ends up with cash, all of us want to make more of it, is not about a profit story. So the way the story works, the first chapter, every business is pretty competent on. What's their revenue? What's their margins? What's their profit? Are they hitting their targets? But equally important to your profitability is your management of 3 items in the balance sheet. Do people pay us correctly? How do we manage our inventory in an import distributor, manufacturer? Or in a service company, how do we invoice the work we do? And do we have the right terms with our suppliers? And I've called that your working capital. So chapter 1 is profit. Chapter 2 is working capital. And if you've invested in infrastructure, plant and machinery, land and buildings, that's chapter 3. And what I have found is that a business is similar to reading a murder mystery book. You read chapter 1 of a murder mystery, you never know who commits the crime. You read chapter 1 profit of your story, you're going to never know what happened to your cash. And that's been my biggest problem all over the world. No one knows what their cash is. They are a chapter 1 storyteller, and that is the way they diagnose and rate their performance.
And you've touched on it early, which is great. This saying, revenue is vanity, profit is sanity, and cash is king. I think it just, apart from the fact that it rhymes, I mean, it just makes so much sense. Why do so many leaders chase revenue, do you think? And what's the cost when they do?
The problem is they have never understood their story. So we've all been brought up that, the more you sell, the better it is. We've never told our marketing people what's the relationship of price and volume to cash, for example. People are making decisions without understanding the impact. The numbers have always belonged to the accountant. The accountant does a great job in business reporting. Everyone owns the number. Imagine if everyone in your company, your sales, marketing, operational, financial people understood the story in the same way, and then they understood the levers they can play with to make the story better. So my whole life has been around simplicity. I've always said, in every technology we've ever developed, would a non-financial person understand this?
Yeah.
And Brad, the basis comes down to the technique why Vern Harnish, the great thought leader of our time, the author of Rockefeller Habits, then Scaling Up, approached me. And Vern realized you can survive with decent people, decent strategy, decent execution, but run out of cash and it's game over.
Yeah. Yeah. And so many businesses do because they're focusing on revenue, which you need to have a holistic view of the numbers. And that's, I guess, what I love about yours. It is the simplicity of those numbers: profit, working capital, other capital, and cash, and the way that they kind of come together and are so essential. So you kind of touched on this briefly, but you talk about the 3 cash flow numbers that every CEO must review each month. So what are they, and how do you think leaders should build those 3 numbers into a rhythm?
Okay, so the first thing is what I said earlier. A story of numbers is told over 4 chapters. Chapter 1 is your profit. Everyone understands that. I can train a non-financial person. Are we hitting revenue targets? Are we hitting our margins? Are the overheads, do we have leaky buckets? Are they running in the right level? What's our profit? Your management team are also responsible for 3 items in the balance sheet: your collections, your inventory or work in progress in a service company, and how we pay the suppliers. There's only 7 levers a company can play with to improve your profit and your cash. The 7 levers, which we've called the power of one, should be in the DNA of everyone's head in your management team. The 7 levers are price, volume, margin, and overhead. So there are 4 profit levers. Then there are 3 working capital levers: receivables, inventory or work in progress, and payables. Those are the inputs into the game called Make Me More Cash. So as you said, there are 3 critical cash flow measures. The CEO of a company is responsible for everything in a company. I can measure them on your profitability, on your working capital management. Are we investing in assets that are giving us a return? and the result is cash. Cash is calculated simply by the movement in all your bank accounts. So in other words, the movement in cash at bank, short and long-term debt. So whenever I go to a board meeting, the first thing I look at is your net profit, and then I compare it to the movement in the bank accounts, and I want to explain to the team, why have we made a great profit, but yet we got no cash? And it's explained over those 4 chapters.
Yeah.
The management team of the company are responsible for cash flow measurement number 2. It's called operating cash. Management team. I can only measure you on what you control. You control the revenue, the margins, and the overheads. So from a profit perspective, I can measure your management team on operating profit or EBIT, but I can also measure them on the 3 items in the working capital: receivables, inventory, and payables. The management team's got 7 levers to turn a company around. The 7 power of 1 levers. The management team should understand what color code green looks like in a company. What should the revenue be? What should the margins be? What profit should we make? How many days should we collect in? How many days of inventory? How do we pay the suppliers in days? You've got to run your company in color code green. Whenever your company's not being run in color code green, how many 1% changes do you need to make to get back on track? The management team needs to be accountable for what I call mind the gap. Everyone in a management meeting should be discussing improvement. How many 1% changes do we need to make to get back to green? Not reporting, which is for an accountant.
About 10 years ago, you came and spoke with at our gathering, a group of clients, and you walked us through how you use the power of 1 with boards. It was slightly adapted, but it was utilizing that in a board sense. And I just found it remarkable, the compounding that you achieved when you were doing it. I think it was quarterly, it might have been monthly, but just over and over, just coming back to the power of 1 and tweaking it and asking those questions and over and over and over. Maybe just tell us about that if you can, the consistency specifically about the power of 1 and what you've seen that do in companies maybe.
Okay, so if you said to me in your entire career with everything you've done, what is the one thing that you believe is transforming business? It's the power of 1. In the Cashflow Story software, by entering some basic numbers, we will produce for you what the 1% changes in price, volume, margin, overhead, and the 1-day changes in receivable, inventory, payable does to cash and profit. People cannot believe in business what the 1%ers do.
No, I agree. They can't.
No, it is these small tweaking changes turn companies around. And then, Brad, no one knows the relationship between these levers. I mean, if I'm going to ask a question, and all people listening today, if you cannot answer this question, you've got a major blind spot in your company. What does a 1% price increase do to profit and cash compared to a 1% volume increase? Your salespeople are making decisions every day. Let's give a discount to sell more. They've got no idea what they're doing to your business. Let's make a sale, but don't educate the customer the payment terms. Now, one of my absolute philosophy in business is the concept of everyone on your management team needs to understand the story through the power of 1, and they need to think about improvement in every transaction. People say to me, how do you get such amazing changes? And it's like Jim Collins' flywheel. You put these little 1%ers every day of your life, and then the inertia starts to happen, and people one day say, my cash flow's fixed, they've got no idea where it came from. And that's what happens in every business. It's these little 1% changes that eventually transform your business.
Thank you. I'd like to ask you about sustainable growth. And that's a specific phrase, and it's within the Cashflow Story report specifically. Now, I connect that back to a massive aha moment back in Boston, again, when I first met you. And you explained how, given your current revenue, if you add $100, now this is probably incredibly simple for you, right? If you add $100, it's going to cost you X number of dollars in working capital to fund that. And then the principle, it was probably one of the first times someone really simply explained working capital. So could you just give us maybe a brief overview of your phrase sustainable growth in the context that I've given?
So firstly, I'm going to say at least 40% of companies I see, the more they sell, the more their profit they make, but the worse their cash flow gets. And no one understands why growth sucks cash. So the concept is, let's explain your business as $1. And I'm going to make this up. A company sells $1 more. Everyone gives me the same answer when I say, tell me what happens. Everyone says I make more margin. I make more gross margin. So let's assume a company sells $1 more and they make 50% margin. The next dollar they sell, they make 50 cents. What they don't realize is that with growth, you need working capital to fund your growth. And working capital is 3 items: your collections, your inventory or work in progress, and payables. In a lot of companies I meet, their working capital timeline, their working capital cycle is stuffed. They don't collect properly. They got too much inventory, or they don't bill the work they do frequently enough, and haven't negotiated the best terms with their suppliers. Many companies, the next dollar they sell, Chapter 2 working capital borrows more money than what you generate in Chapter 1 margin, and volume is detrimental to cash. Another question I'm going to ask every one of the people listening today. Do you know in your company your cash flow ladder? If you segment your company down by business unit, if you sell $1 more, tell me where you make the most money to where you lose money. Do you have a cash flow ladder in your company? And then have you taught your staff for each segment of your business what we can do to improve that particular business unit and make it operating color code green? So sustainable growth is the concept. If I sell $1 more, how much margin do I make? Let's say 50 cents. How much working capital do I need to fund the next dollar? Let's say 40 cents. I now make 10 cents cash at gross margin. The next part is your overheads. As you grow your business, how much will your overheads grow for every dollar? Now, overheads are fixed and variable, but almost every company I see around the planet, their overheads are growing at probably a similar rate to revenue growth, even though companies say to me, my overheads are fixed.
Yeah.
So sustainable growth is you sell $1 more, what's your margin? How much working capital do you need? What's your cash flow at gross margin? Do you need extra overheads to fund growth? And then how much will you need to borrow from the bank to fund the next dollar you sell?
And it just makes it so simple, because then you can say, well, currently you're at, I don't know, $10 million revenue. If you sell another $100, you're going to have to fund that with $3. I say that it's so simple, and I'm so, I guess, expressive, because it's so confusing until you get it. And it's confusing because it hasn't been so simply explained, I suppose, for entrepreneurs.
So, Brad, I always say one of my first opening lines in any board meeting, any presentation, what are the traits of a leader? Ability to predict is number one. So I go into a board meeting and the CEO says, this is what's going to happen next quarter. And they miss it. Then they say, this is what's going to happen the next quarter. And they miss it. I know I've got a problem in the company. The next trait of a leader is the ability to delegate. Get a team of A players who work for you, who love to win the game. And then the last thing is repeat, repeat, repeat. What are the top 2 or 3 things you need to do and become a stuck record? With my process, if you repeat this methodology 2 or 3 times in a company, in every board meeting that I have, we always start with the numbers first, because that dictates your strategy, your people, your execution that you need to do.
And what needs to be done?
But you've got to know your story. And as a team, we all, if we A players, want to improve the story, but we got to understand the story in a simple way. The improvement is through the power of one. The measurement is that everyone in your company needs to know. And if I had to write another book, I would call it, What Does Success Look Like? What does color code green look like? And what are the changes we need to make to get there? Mind the gap.
You mentioned A players there. One of the challenges, I want to say challenges, but I'm going to say opportunities that we've come across is accountants or people in the profession who are more focused perhaps on producing a set of numbers and books that are more about compliance than business numbers. What advice could you give to help people to maybe encourage or get their accountants to deliver business numbers and to understand that they've got maybe 2 masters to serve, for want of a better term?
So, Brad, you asked a question 30 years later. I'm still trying to solve this problem. But the accountants are either my best friend. So when I do so many CEO presentations, the CEO goes back, says to the accountant, I've seen something amazing, you need to do it. That's the worst approach you can ever give. Because the CEO says, I know the stuff, I'm doing it. It's not about the CFO. The CFO should be the person who's helping the team. The CFO needs to realize this has got nothing to do to challenge their reporting. They're doing brilliant jobs. This is about improvement. This actually belongs to the CEO in a company.
Mm-hmm.
What I'm doing belongs to the CEO, but we need to get the CFO bought in. And that's why whenever I give a talk, I say, bring your CFO, because they're my best friend. Once you've shown them what you do. But if you challenge them and say, why aren't you doing this? You've got them offside straight away.
Yeah.
CFOs understand what I'm doing. I'm just teaching them a methodology to deliver it.
Yeah, nice. What's the difference between a 3, a 4, a 5 multiple valuation? Now, I know it, and I know it's strategy, and I know that's the other things, but I'm interested in your take, because through the power of one, we know that the little changes can have an impact on valuation. And you kind of alluded to that before. Do you feel that the consistency of performance can have an impact on the multiple of a valuation at all? Or is it simply dictated by the market?
So again, that's a great question. Every single board that I sit on, whether the company's trying to exit or not, one of the first questions I ask when I join a board is, in 3 years' time, if someone brings a checkbook to us, how big does it need to be? And then I do a valuation today, because we know their multiple, because that would be available from their accountant, or we'd be pretty close. And then we say, well, how do we now need to get the next 2 years or 3 years right to achieve our target? And again, evaluation is based upon 3 items: your EBITDA, your multiple, and when you sell your company, you obviously have to repay your debt. So it's your EBITDA, your multiple, and your debt. So the first thing what I want to do in an organization is to get them to double industry benchmark. So we We put in all of these methodologies to get to their industry benchmark, and we significantly higher. And then through your advisory processes you're using, and there's some, I know you use an amazing one. We want to prove to other people this is not about luck. If you had to add additional companies into this ecosystem, we could replicate it over and over again. And that's when you get a much higher multiple. So the multiple is critical. And that's about people, strategy, execution, and then obviously getting a profit far higher than the industry. And then obviously you need to show your basis for growth.
Yeah.
So someone says to me, tell me a financial ratio that's important. And I say to them, QV. And they say to me, QV, is that the Queen of England? I say, no, it's your quality of earnings. We need to absolutely nail in a business the ability to predict, an ability to generate performance which is well and above the industry benchmark, because your company has a methodology of operating that is different.
Yeah, because that's the predictability, because it mitigates the buyer's concerns or opportunity to mark down the valuation.
Exactly. You've got to be able to prove that this is not about luck, and this ecosystem that you've created, you can add multiple other additions into this business and it'll just completely help scale the business.
It feels like we're currently in a bit of a glitch in the world, a bit like COVID, perhaps. How do you see artificial intelligence changing the way businesses are valued? I guess, especially when it comes to the power of one or cash flow profit multiples, that type of thing.
So it's interesting. The world's changing without a doubt. If companies don't adopt AI and what's happening around you, I always say when the rate of change externally is greater than the rate of change internally, the end is in sight. So one of the companies I've just exited, which was an EO member, I was the chairman, we were in skin cancer medicine. So we owned skin cancer clinics, and we realized as well there's a lot of changes coming in those industries we need to adopt with change. So a lot of companies think my industry will never be hit by it. I'm not a technology person, even though I've got a technology company. But I can tell you now, every single company review I do, even with the power of one, I put the power of one into AI. And I say, this is the company, this is in the industry. Give me some ideas how to improve 1% in 1 day. So it's at our fingertips. If we're not using it, someone else is.
Yeah, that's awesome. That's awesome. And I think you've kind of touched on it briefly, but you've got to embrace it in some way. You've got to, a lot of people I've seen, or several people think that our third-party software suppliers will bring out an AI tool, and so we'll just use that when it comes out. But I think it is a societal level change, and we've really got to jump in.
And I think in every single company listening today, why don't you run a series for your team to bring in someone who's an AI expert in the field to come and speak to the team and show them what's going on. I attended a board meeting a few days ago in Brisbane. We in food distribution, and we got an AI expert to come in on our data, and people were on the ground with what is in their database, the analysis we could have done.
Yeah.
And even with processes, how to improve processes.
Yeah, that's awesome. That's awesome. So I want to talk about good debt and bad debt. So it's something that I've heard you talk about before. What's the difference between good debt and bad debt? And what's the simple test that listeners can use to know whether borrowing is funding a smart growth or it's covering up poor management?
I love your question, Brad. Great question. Cash flow's the result. When a company grows, there's cash flow impacts. When a company declines, there's cash flow impacts. But cash flow is the result of growth or decline and the result of management. Management, you've got 7 levers to play with that impact cash: price, volume, margin, overheads, receivable, inventory, WIP, and payable. When a company is borrowing money because they're running in color code red and yellow, I've got a problem. So in other words, if we have to go to the bank because our margins are dropping, we're collecting too slowly, then we're borrowing money to fund bad management. When a company is growing and they're running in color code green, I love going to the bank to borrow because we're funding for the right reason. So when I'm looking at a business, banks, and I should have said this earlier on, my first business, we sold technology to the credit department in the banks. The banks either bought the Moody's software or they bought our technology, and eventually we got to about 500 global banks. Every bank around the world looks at one thing called debt service capacity. Today's debt is repaid by tomorrow's cash. Do you have enough cash to pay your interest and your maturing debt? Every business was looking at profit. That's why business spoke Spanish and bank spoke Portuguese. My message to every company, the banks know your cash flow better than any other organization on the planet because cash flow is the movement in bank accounts. If the bank's worried about you, it means you've breached one of the bank ratios which measure debt service capacity. If the bank's worried about you, you should be worried about you. And the way you fix it is the combination of the 7 power of 1 levers. So good debt is when you're borrowing to fund growth. Bad debt is when you've got borrowing money to fund an inefficient management team. And people often say to me, well, interest is cheap. I don't mind borrowing. And my answer is, would you rather have money sitting in other people's bank accounts or yours? Trust me, I would rather have money sitting in my bank account because I'm running the company in color code green.
So I want to take you back to 2009, the height of the global financial crisis. This is when we first met in Boston again. And you come out with this phrase. Now, I don't know if you picked it up, but I think that there were many of the entrepreneurs in the room who were a little bit uncomfortable about this phrase that you said and were maybe going to throw something at you. And that phrase was, your bank is your partner. Tell me, why should entrepreneurs think about their bank being their partner? Because for many entrepreneurs, it can seem a bit of an adversarial relationship.
Okay, so great question again. So the accounting equation, a balance sheet can be explained in one sentence. I've changed the accounting equation and I call it funding equals operations. Funding is either debt or equity. Operations is there's 2 components in your operations, your working capital, the 3 items I've been talking about, and the rest of your balance sheet, primarily your fixed assets. Debt sits next to equity. If you treat your bank like a partner, the bank is much more likely to be a supporter of your business. The worst thing you can ever do to a bank is give them a surprise. That's the worst. If you want to kill a banking relationship, give your bank a surprise. And the other thing is, if you do well, the bank does well, because the bank's got absolute surety over their capacity to get repaid. The bank wants you to do well. The bank, if you've got a problem with your bank, there's only 7 ways you can communicate to the bank how you're going to fix the problem. And it's the combination of the 1%ers and the 1-dayers. My problem is, Brad, people meet the bank. They think they've had a great meeting by telling them all the good news. They talk about profit, and the bank walks out, and the people who weren't in the meeting were the credit guys, the guys you don't meet. If you can understand the story of cash, the bank will love you, and your journey as a business will be better. So my philosophy to most companies are, obviously, get the bank on side, become a cash flow driven organization, make everyone in your company understand and be part of the story. And it's all about improvement, not about reporting. So the bank is your partner. You both get a benefit.
Yeah, very nice. So I'd like to switch gears. Every guest I ask the same question of, and it's about a better business. So if you think about it, how would you describe a better business? Now, the context is the book that I have coming out soon is entitled Bigger Isn't Better. Better is better. So it speaks to, rather than putting another zero on your revenue, perhaps, try to do the work to build a better business. So how would you describe a better business?
To me, again, if you look at the 4 decisions, so a team of A players, a differentiated strategy with a meticulous focus on your core customer, execution excellence, and a company who's obsessed with the 7 levers and cash. A better business is a business under control where you can predict what's going to happen. And again, this applies to certain businesses. The biggest problem in business is when you fall 1 month behind, then you're 2 months behind, and you play the game called catch up. In every business I work in, who invoices every day, where you can actually budget by the day, at the beginning of every day, I send everyone in the company an email, or not me, an email is sent. This is our target for today. This is the gross margin dollars we need to generate for today. This is what we did yesterday. Did we hit our budget? This is what's left to do for the month. And you bring budgeting down to a daily basis. Then maybe midway through the day, you again send an email to everyone. We're now at 1 o'clock in the afternoon. We've got 4 hours left. This is what's left to do for the day. Companies who budget in very small slots and make it a game don't miss targets. So what does make a good business? Again, ability to predict, ability to delegate, and then repeat.
Yeah, that's great. Thank you. How can people learn more about you, the work you do, and your business?
So go to my personal website, Alan Miltz. Cashflow Story is the way we've converted all the concepts into a software. So Cashflow Story is a global technology platform, doesn't replace anything or any reporting you're going to do, but it's about strategy. It's about the 1% is the power of one. So to me, what are the best changes I get? And I would get an email every day from somewhere around the world. Implement the power of one in your business, you'll have a different business forever. And it's easy. So one of the first starting points, Brad, would be once you've listened to this session, sit down with your team, write the 7 levers down the side of a whiteboard, give everyone little sticky notes, and then workshop lever by lever. Where can we put prices up? How do we improve volume? How do we grow margins? Leaky buckets in overhead. And take the top ideas and you repeat this over and over again every quarter. This is how I get change in a business.
Thank you. What haven't we covered off today that you wanted to cover off?
I think the main thing is don't be scared. Embrace the numbers. I can honestly say when I first start off, people typically when they have a meeting, the accountant's given them 20 or 30 pages of reports. No one's ever read them. No one understands it. Imagine. So if you said to me, what does ultimate success look like? If I meet your listeners, your followers in 3 or 4 months' time, the following would have been implemented. The power of one is implemented in your business. We discuss your financial story on one piece of paper, the 4 chapters, your profit, your working capital, the rest of your balance sheet, mainly your fixed assets, the result is your cash. Everyone knows in the company what success looks like. What does color code green look like financially? Revenue, margins, profit, collection days. Everyone in your company knows the changes required to get back to color code green. And then we segment your business and we know where we're making or losing money in the company. That's what a great business looks like, and that's what success looks like.
Well, Alan, thank you so much for sharing your wisdom today. I guess you can only make something simple if you really deeply understand it, and that's what I appreciate about yourself. It is the deep understanding that makes it simple for other people to understand. So thank you again for sharing your wisdom today. It's been such a great pleasure.
And thank you for inviting me to be your guest.
Well, I hope you enjoyed the episode as much as I did. If you'd be kind enough to leave a review for the podcast, that'd be really helpful to other like-minded entrepreneurs, and then we can grow our community. If you want to find out more about our guests, head over to evolutionpartners.com.au/podcast, where you can find show notes and other additional reading. Hope to see you back next week. Until then, keep thriving.